In order to be successful in trading and investing, you need to understand financial markets, market trends, and cycles. Let's dive into exactly what they are. A market is simply where buyers and sellers meet to trade. Going to the grocery store to buy apples is an example of a market. The price you pay for something in a market is dependent on the balance of supply from sellers and demand from buyers. If the grocery store is struggling to supply apples, but consumers want to purchase lots of them, the price will increase. If there is no demand for apples but a huge supply, the price will decrease. Anywhere supply meets demand, a market exists. Financial markets take the same concepts as our grocery store example, but instead they deal with financial assets. Supply and demand create the market and determine prices, but what exactly makes up the levels of demand and supply in a market? The amount of assets supplied for sale in a financial market has many reasons behind it. For example, the supply of gold can be affected by the amount mined, production costs, and import taxes and tariffs, among other things. The overall demand in a market like gold can be affected by the state of the global economy, returns on alternative investments, and other factors. Many see gold as a place to store money when there are economic problems or in an emergency. If financial markets are down and we are perhaps entering a recession, some people like to invest in gold as a safe haven, causing the demand to increase. Whether we are talking about apples in a grocery store, gold on financial markets, or cryptocurrencies, the principles of demand and supply are always the same. The only difference will be what affects supply and demand in each financial market. There are two main types of market trends: bullish trends and bearish trends. A bullish trend would be a noticeable increase over a period in the market price of an asset. A bearish trend is a noticeable decrease in an asset's price over a period. Market prices can also move sideways, otherwise known as consolidating. In this case, there's no clear directional trend. As these trends continue, we can describe a market as being bullish or bearish. If there has been a string of bullish trends in a row, we can probably say that we're in a bull market. The same goes for a period of continued bearish trends. In this case, we could assume that we're in a bear market. However, a bull market doesn't have to be one long, continuous, and constant rise in price. Sometimes a bull market will have some smaller bearish trends in it. The same goes for bear markets too, as they can also have some bullish trends in them. In fact, we only get the full picture much later, and we can only determine markets and trends with certainty and hindsight. Lastly, you may have heard that the market moves in cycles with repeating trends. Almost every asset will experience cycles between bullish and bearish markets. Long-term market cycles are more reliable than short-term market trends and can be easily seen on graphs with decades of data. If you take a look at the stock market's performance or crypto markets over the past few years, you'll easily be able to identify the market cycles. Shorter cycles will appear as you zoom in on shorter time periods. As with market trends, it's challenging to determine what stage of a cycle we're in and when a new one will begin. Understanding market trends and cycles is critical to be successful in trading and investing, but getting to know how market psychology impacts market trends is equally critical. We will learn what market psychology is in the next module.
Now let's look at what you have learned in this class. Answer this question in the comments, and if it's correct, we'll let you know with a like. In a bearish market trend, the price is A. Always increasing. B. Mainly increasing. C. Always decreasing. D. Mainly decreasing. E. Moving sideways.